to another episode of the Federal Church Presents Better Than Bloomberg. Coverage of the 2023 banking collapse. Another good note from Zero Hedge. The liquidity phase of the bank crisis is over, but the solvency phase is getting worse because you have inflation and rates will keep rising, whether the Fed or ECB likes it or not. The acute phase of the banking crisis appears to be over. As was revealed late on Sunday, just around the time futures opened for trading, the Fed's new Bank Term Funding Program, which should stand for Buy the Fucking Pivot, a facility designed to avoid banks that are facing deposit outflows from being forced to sell. A facility designed to have banks that are facing deposit outflows from being forced to sell their bond holdings at a loss, which they like to avoid because it looks pretty bad. And which, as JP Morgan concluded, is a stealth form of QE, which can be as big as $2 trillion and even bigger if required, will serve to backstop small bank impaired assets for the foreseeable future. Then today's deposit consortium plan unveiled as a part of... There we go. Plan unveiled as a part of the coordinated rescue First Republic Bank, which envisions big banks like JP Morgan, Chase, and Bank of America injecting tens of billions of newly received deposits into the troubled bank, which are meant to be replenishing its own lost deposits, which ended up fleeing to the same big banks, which are now recycling them in the form of a bailout. Do that other video where it's kind of a ridiculous thing where they had the facility the Fed created has created a blueprint of how to backstop the liability side of small banks. Simply said, any deposit that JPM received from a small regional bank XYZ will probably be recycled as a new deposit back in a small regional bank XYZ to keep it liquid. But now they have no depositors, and they still have the bunch of worthless toxic debt. That last word is critical because the asset and liability backstop, the liquidity phase of the banking crisis, is now over. But what about the solvency phase? Exactly, the part where they still have toxic debt that makes up their entire capital base. Their entire reserves are not worth as much as it should be. So, now with fractional reserve banking, the depositors will no way in hell keep their money there. Well, therein lies the rub, because as readers will recall, around the time the regional banks started slumping, we wrote, "Why small banks are in big trouble as hedge funds pile into the new big short. The next credit event emerges," which focused not on the small bank net unrealized losses on their held-to-maturity portfolios, or the bank run sparked by the sudden collapse of SVB, our Silicon Valley Bank, which was still quite solvent at the time of our article, but on the real solvency risk facing the regional bank sector, their exposure to commercial real estate in general and office buildings in particular. Specifically, in the article, we explained why after residential real estate, malls, and hotels, all of which represented the various big shorts over the past 15 years, it was now offices' turn to crumble. We won't republish the whole article here. We will rephrase the big rhetorical question we asked them. What happens as the troubles in the office sector, which had been isolated to the real estate realm so far, start spreading to the broader banking sector? After all, both previous big shorts, versions 2.0 and 3.0, were mostly isolated phenomena thanks to the low rates that prevailed in 2020 and much of 2021. That has now changed, and suddenly investors are starting to look at who amongst the U.S. banks has the most exposure to crashing commercial real estate, and offices in particular. For now, investors are taking a shotgun approach, dumping the regional and small banks en masse, with the KRE ETF plunging to the lowest level in 2 years. The broader BKW Bank Index suffering its worst day since June 2020. Little did we know just how much worse it would get in the next 2 days. While arguably the most popular office REIT, Vornado, just hit the lowest since 1997. As we concluded, the problem, and this is where the discussion of the coming credit event kicks in, is that while large banks are still very well capitalized, well, that's arguable too, Small banks, the core constituents of the KRE index, are in big trouble because, as the following chart from TS Lombard shows, their reserves as a percent of total assets have collapsed as a source of funding for loans and are back to levels when the Fed needed to do QE to reload their reserves. That isn't an entertaining one, too. See how bad that is. If I can make it smaller, it's getting in the way, but it's all the way down there. You can see it in the smaller icon there, the part that's circled. When we excerpted from T.S. Lombard's Stephen Blitz, full note available to Pro Subs, explaining why we may be this close to another banking crisis. Spoiler, we were. And you're in it now. Banks, and especially small banks, are now sitting with reserves pretty much at their lowest comfort level. This is not much of a cash-to-asset cushion left for small banks as a whole. So a funding crisis can easily get rolling if large depositors decide too many loans in commercial real estate and other areas are about to go bad. Not to mention the treasuries, which is most of it and most of their reserves, and it's pretty bad. The Fed will make funds available to keep those banks afloat, but that alone will get some pushback from Congress because of the increased concentration of bank deposits and an increase in the smaller number of banks. Small banks could have slipped below the promised macro supervision radar owing to the political direction and lighten the regulatory burden on small community banks. The belief is that they should not be subject to the same reporting requirements as the GSIBs, the systematically important banks there. Ahead of any banking problem rooted in bad loans turning into a funding problem, banks are going to pull back on lending at an even faster pace. And included, translation, not only banks once again are reserve constrained, because not just of the toiletries, but because of the toxic commercial real estate, but small banks are especially desperate for reserves. Well, we were right, as JP Morgan's analyst conceded today. Our take was spot on because not only were small banks reserve constrained and imploded promptly after we wrote our preview of the new Big Short, but the Fed launched a new stealth QE program in the form of the by the fucking pivot facility, which may have to expand to $2 trillion or more with a T, which means that we now live in a time when 1, the Fed is hiking, 2, the Fed is shrinking its balance sheet via QT, and 3, it's injecting up to $2 trillion with a T in liquidity via the by the fucking pivot facility, aka stealth QE. Our conclusion from Thursday was also prophetic. In conclusion, even without the office real estate crisis, small banks were already headed for an unsettling mix of reduced funding and more underperforming loans. Throw in a cascade of bad debt and exposure to office real estate, and you could see a repeat of the 2009 banking crisis for the small banks, if only in the beginning, because once the small banks go down, the big banks won't be far behind. That's the important part. Less than a week later, as noted above, we have gone through a full-blown small bank crisis cycle and the acute liquidity freeze is over. But the solvency part remains. And after that very long preamble, we finally present the core of today's post. Namely that even as regional banks are surging today on the easing in liquidity, the solvency part is getting worse. Recall in our Thursday post, we said that readers should keep a close eye on the office sector, i.e. the Big Short 4.0 trade, whether in the form of the CMBX S15 negative triple B tranche or equities and REITs. And today, while everything else is surging, one sector is having a very bad time, a very hard time. You guessed it, office, commercial real estate. Again, they can be cheerleading all the bullshit on Bloomberg and CNBC, but they're telling you to look over here when you really should be looking over there. Office real estate there. As shown in the charts below, office building landlords are some of the biggest decliners among U.S. real estate stocks Thursday, on pace for the lowest close since August 2009. Below we summarize the damage. The S&P Composite 1500 Office REITs Index drops as much as 4.9%, just as the Reverend had prophesied. While the S&P Composite 1500 Real Estate Index dropping as much as 2%. And the beautiful part about that is that it's going to cascade as it goes down, or snowball as it goes down, as more people realize they need to get the fuck out of it. So, that's how that stuff works. With the S&P Composite 1500 Real Estate Index dropping as much as 2% as the banking crisis continues to weigh on real estate stocks. Office giants such as Vornado Realty, Hudson Pacific, and SL Green are falling as much as 7% or more. Should be probably much more. Other decliners include Piedmont Office Realty Trust, negative 4.5%, Cousins Property Inc., negative 5.9%, and Kilroy Realty Corp., negative 6%. The longer-term chart of Vornado is terrifying. The stock is back to levels last seen in November 1996. Worse than 2008. Our preferred trade, which we highlighted last week, the CMBX S15 negative triple B tranche, which has outsized exposure to offices, just hit a new lifetime low, and so on. The bottom line, the acute phase of the bank crisis may now be over thanks to the Fed's stealth QE and JP Morgan's recycling of newly acquired regional bank deposits back into the same regional banks that saw bank runs in the past week. But now the slow burning, well, I don't think it'll be that slow, because it doesn't change the fact that those banks and their capital, their reserves, are not there. So if you're a depositor there, you're screwed. So nobody's going to be a depositor there. Phase is starting to accelerate, and until the Fed cuts rates, expect a mood, sentiment, and price roller coaster as investor focus increasingly turns to what is the next big threat, not to mention the next big short facing the financial sector. And yeah, you should expect that throughout, basically all those sectors. The price roller coaster, the volatility, because you're going to be seeing these people basically doing the same thing as in 2008. Like there's this other article here, VIX rockets to 2008 financial crisis levels. Yeah. There's a reason why the volatility index does that. Well, it's because on the way down, people don't like to accept the reality that it's well on the way down. That, all these indices are on the way down. Just like they try to tell themselves they don't have a banking collapse when, they have a headline that says, oh, look, they created this facility, or, oh, they bailed out this much, or they bailed out Credit Suisse for $54 billion, blah, blah. No, it doesn't change the fact that the insolvency is there for basically a lot of banks. A lot in your banking system there. So, as, they keep trying to cheerlead on the TV there, the CNBC and the Bloombergs, psychologically people be, oh, everything's fine, we can go back. No, nothing changed. And it's just like in 2008, on the way down, people, would just be, kind of denying the reality, and then they figure out, oh, wait, that doesn't really change anything. Just like the facility they had, that doesn't change anything. Oh, but it sounded nice. So, on the way down, you just see the volatility. And that's how it was in 2008, too. But that was a pretty good note from Zero Hedge. And on to the other important ones, too. Don't forget to donate. Your donation is your salvation. Don't forget, you're in this mess because you didn't donate. You didn't pay your tithe. And now that Jesus is very angry with you. Don't forget to donate those Rolls Royces.